A very good day to all my tech enthusiasts out there. Today, we are diving into new horizons, and we're going to analyze a topic quite alien to the general public, blockchain technology. And no, it does not have anything to do with supply chains or building blocks. The term has made waves of late with the rise of cryptocurrency. However, most non-crypto fans do not know what blockchain is or its applications. So let's take an educational trip down technology and understand blockchain in very basic layman's terminology so that we can move on to higher order tech in future videos. Before we get into the video, make sure to drop a like and hit the subscribe button. If you enjoy what you watch and would like constant updates on more of the fintech world, click the bell icon to be notified of our latest uploads, and on to the video. Blockchain technology is one of the foundational pillars of financial technology as we know it today. It was created by Satoshi Nakamoto in 2008. It is a system of storage of public financial records in an organized database. The storage structure is called a block, while the entire database is called a chain, and thus arose the term blockchain. Each individual has their own digital ledger, which contains a record of transactions. Any kind of updates to the ledger can be made only after the party initiating it authorizes it with their digital signature. The database is open to general public for access, but only authorized individuals can interact with it. The key difference between blockchain and standard conventional databases is the way in which the information is stored. Normal databases store information in arrays or tables, adding cells upon the introduction of new information. Hence, data is stored on an individual basis. On the other hand, blockchain clumps data together into blocks of certain sizes. When each block of information is filled, it becomes permanent in the chain. New data is stored in new blocks, and so on. The interesting part is that blockchain collects temporal data whenever a block becomes maxed. Databases can also be edited by everyone who has access to it, while blockchain can be accessed by everyone, but can be edited only by authorized personnel. Blockchain hence proved to be more credible for recording large financial transactions and is now used by Bitcoin entirely over other databases. So how does blockchain work? When a party undertakes a new transaction, it is entered into the system and transmitted to peer-to-peer networks all across the world. These networks then test the validity of the transaction. If the result comes in the affirmative, the storage is updated by adding transactional information into blocks, which are then attached to the chain. All information in the blockchain is secured using hashing and encryption. Compared to traditional information storage systems, blockchain is definitely an improvement in terms of security. Blockchain is done in real time, with speed and convenience greater than almost all other systems. Moreover, users manage blockchains entirely, which means there is no central governing body or central institution keeping an eye on the transactions. As a result, there are significant cost savings for all parties transacting through blockchain. The lack of a central authority implies that no transaction fees will be collected. In addition, the chances of errors arising in blockchain authentication are extremely low. When peer-to-peer networks validate transactions, unless an error is committed by more than half of the network, the transaction is verified accurately. Blockchain is also being recommended as a solution to reach remote areas where the banking system could not penetrate. However, while blockchain has its merits, it also brings along certain disadvantages. Once a block is filled, it becomes permanent in the ledger. Altering any filled information becomes highly challenging in blockchain, unlike regular databases. It is also time-consuming to add a new block every time a block is filled. Moreover, the encryption relies on private keys for decryption. Private keys are often irregular and not standardized. Lastly, blockchain is limited in terms of volume, as only a certain amount of information can be stored in each block. The average blockchain can process only 7 transactions per second. Handling multiple transactions at the same time is likely to overload the system. We have all seen Bitcoin get banned in India out of fear that it may be used to finance terrorist activities. This convention was not based on mere fear, but on the tenets of blockchain. The system's high level of privacy can be easily used by criminals to protect their own identities and transactions. An example of this was the Silk Road website used by the dark web to smuggle and distribute drugs on the black market. However, governments are now working to prevent such problems via regulating parties on the blockchain network and not the blockchain system itself. Blockchains exist in 4 different forms, catering to different purposes. The first one is private blockchain. As the name suggests, this system runs on a closed network within which data is transmitted. They are highly beneficial for private organizations to manage internal operations. In a private blockchain, only one entity is allowed to edit and update. The second type is, you guessed it, public blockchains. They are accessible to the public at large and spread across a wide network. Cryptocurrencies such as Bitcoin and Litecoin are traded with the assistance of public blockchains. In addition, a large number of people are allowed access to edit. Public blockchains have extensive security measures as they contain data belonging to a vast range of people and transactions. There is a third type of blockchain, which is a mix of the previous two. Permissioned blockchains work the same as private blockchains, but with one single difference. A group of individuals have authorized access and not just one. It is best suited for companies with multiple decision-making authorities and hence want a secure system with multiple access points. The last variant is the consortium blockchain. They have high security and are coded similarly as permissioned blockchains. Consortium blockchains are suitable for organizations looking to collaborate with other organizations and wish to run a single common network through them. This can be useful for joint ventures and mergers. They are, however, more complex than a simple private blockchain. There are three ways in which interested individuals can put their money into blockchain technology. The first is investing in blockchain applications, such as Bitcoin and altcoin, the most common users of blockchain. Another method is to invest in research and development in blockchain technology itself directly. And lastly, new startups have risen of late that run purely on blockchain. Finally, there are internet applications as well that use blockchain as a means to raise capital. These can prove to be profitable investments in the long term. And that's it to wrap for this video. What do you think of blockchain technology? Is it lucrative to invest in it? Will it replace existing databases in the future? Or will it be a security concern with the rise of better hackers? Let us know your thoughts in the comment section down below. Make sure to leave a like and subscribe if you would love to see more of your favorite technical concepts broken down in the future.